The small cap underperformance has been something that's been tied to the economic narrative. This idea that if a recession's coming, smaller companies and their balance sheets wouldn't be able to withstand it as much. The narrative has somewhat changed, but interest rates are a big part of that story. Why?
Yeah, you got it exactly right, Dom. But small cap companies are more in the loan market. They can't really term out their debt. So when the Fed raises rates, companies like Microsoft, Apple, Google, they're pretty much insulated from those rising rates. They don't really care, and they're actually, frankly, earning a lot of interest on their cash balances. So it's actually rising rates are probably good for their balance sheets. But small companies can't really do that. So small companies are definitely investors are far more scared of the higher interest rate impact on their balance sheets. Coupled with this idea that we are having a slower growth environment. Now, we've been in the camp where we're not going to have a recession. We're going to avoid it. We've been in that camp for a couple of quarters now. But frankly, the market doesn't really it has not been on board with that. And so, the idea that a slower growth environment coupled with balance sheet challenges has made, the small caps not really a place for investors to be most of this year.
Scott, does that mean that the bid that we've seen in small caps has been driven mostly then by the interest rate narrative that we've seen, this bid for government bonds that's now pushed benchmark 10-year note yields below 4.4%. So it's almost like the same thing helping mega cap technology stocks like that Magnificent Seven is also now helping those small cap stocks in this kind of barbell effect.
Yeah, look, John, I think that's definitely part of it. And from a fundamental standpoint, that is definitely helping, and it's helping sentiment at the same time. But there's another driver of small caps we think is probably another driver of emerging markets that's going on right now, especially the last couple of weeks. And that is just the fact that everybody knows the story on small caps. And so investors have generally been, and professional fund managers have been really underweight or even short small caps for much of this year. And so if you want to think about like a pain trade into the end of the year for most professional money managers, it'd be a rally led by small caps and led by emerging markets. And so this pain trade idea, where the things that have just done the worst and people have been under positioned most of the year, leading a rally coming in, people are scared about that, frankly. And so, they are starting to kind of chase and cover small cap rallies when they start to happen because nobody wants to lose performance they've gotten this year.
Scott, the problem with some of those pain trades and those kind of, rallies based upon short covering and everything else have to do with this idea that there's only so much fuel in the tank. It's not really long-term sustainable. If that's the case, what exactly would you do? Where would you put money to work, given the fact that we've already seen a run like we've seen in certain parts of the market?
Yeah, look, if you don't want to be cute, and let's be clear, it would be being cute to get long small caps and emergings here. I mean, it's really for a trade, not really for an investment. So if you want to be cute about it, that could work into the end of the year, but that's something that we're evaluating here at Horizon. But if you want to look out a little bit longer and you don't want to try to be cute with it, then really it's kind of the stuff that's worked most of this year, Dom. It is going to be positioning for the AI revolution, positioning for the quantum computing revolution that we think is coming. So it's still your mega cap tech stuff. It's still your consumer discretionary. We still have consumers that not only everybody's got a job that wants one, but you're getting raises and now their portfolio values are higher, so they're spending money. And the bar for especially on the luxury side, the bar to get over from the holiday season is frankly pretty low, we think. So if we're positioning for a little bit longer term, it is going to be on that mega cap tech side, and it's still going to be on the discretionary side. We do think that the benefits from this productivity boom is going to accrue more to the largest of the large, kind of unlike the internet PC productivity boom we had a generation ago.